The U.S. economy is becoming completely divided into two parts, and it is extremely crucial that we understand these two parts so that we know where to invest our money right now in the current environment. At this time, we're watching the story play out of two economies, one benefiting those on the receiving side of a strong fiscal policy, and the other punishing those on the receiving side of a tight monetary policy. Each sector has to be analyzed separately because the separation between the fiscal policy and the monetary policy is much larger than we've seen throughout history. With extremely high fiscal deficits and public debt to GDP, higher interest rates puts downward obvious pressure on some parts of the economy, think the real estate sector, automotive, startups, etc., while actually stimulating other areas, as higher interest expense and thus larger deficits actually flow out into the economy. The U.S. government's fiscal deficit for 2023 was right at $1.7 trillion. The largest component of the steady fiscal deficit increase is the higher interest expense that the government's paying on its debts. So the question for investors is, who's on the receiving side of those deficits, and also who's on the other side of those interest expenses? One answer is cash-rich corporations like your Google, your Berkshire Hathaway, and ExxonMobil, but certain households are another answer. So consider an upper middle class 70-year-old retiree. They own a home outright with no mortgage, or they've locked in a low fixed rate mortgage. They have plenty of cash and money markets and bonds and equities, and they receive Social Security and Medicare. They're a mini version of your Google or your Berkshire Hathaway. And as the Federal Reserve raises interest rates, it doesn't really affect them negatively at all. In fact, their bank accounts and money markets and T-bills start paying them higher yields, while any debts they have are locked in at lower rates for long durations. So they have plenty of money to spend on travel, restaurants, and other leisures. And for some of them, they help their grandchildren and children pay for these same types of activities. The idea that aging demographics are deflationary makes sense historically, when senior citizens typically live tighter than they're used to. But right now, large amounts of the U.S. deficits are going towards them with your Social Security, your Medicare, and your interest expense, with the seniors and their proxies such as pensions and insurance companies being on the receiving side of that interest. The travel sector suffered for a while, and so there's still pent-up travel demand amongst individuals and businesses. That fact, combined with ongoing fiscal dominance directed at people who have the time and the money to travel, is rather positive for the travel, the restaurant, and ironically, the luxury industry. In other words, the current strategy is to own businesses that upper middle class senior citizens want to spend money on. They're the ones that have a large portion of the country's money, and higher interest rates are actually neutral to stimulatory for many of them. And I really do believe that we're going to continue to see this for the foreseeable future. So our plan is to invest accordingly.